when I sit down with households, I find that one of the biggest aha moments is doing the cash flow analysis, right? So they know what the retirement account balance is and how much is in savings or not, but they don't really know where the money's going. And so this is really, I think, a trigger event where it really, encourages us to, okay, now I need to sit down and really look at these numbers, because if I don't, I can be in a world of hurt in the short term.
Good morning and welcome to Giant Steps with Leilani Brown. Today, I want to ask and answer a question that happens to so many people. I just lost my job and my income. Now what? This episode is going to be about the financial realities of a layoff, not through fear, but through practical and expert-backed advice. And we'll acknowledge the emotions and then replace panic with planning. And I couldn't think of anyone better to have this conversation with than my friend and my personal financial advisor, Mike Daniels. Mike Daniels is a senior financial advisor at Financial Focus Group, a team of financial planners based in Jersey City, New Jersey. He helps clients make smart strategic decisions in the area of savings and investments, retirement planning, risk management, tax, and estate strategies. He is a friend and a partner, and I'm so thrilled to have him on the show. Welcome, Mike.
Thank you so much for having me.
Big change doesn't happen overnight. Sometimes it starts with a single step. That's why I'm excited to host leaders, innovators, great thinkers, and everyday people sharing their stories and practical insights you can use right now. Wherever you are in your journey, whether you're just starting out, looking to make a pivot, or ready to reinvent yourself, you'll find both information and inspiration right here. This is Giant Steps, and I'm Leilani Brown. So before we get into it, I want to make clear that this is not financial advice, and I'm going to read a disclaimer and then give Mike the opportunity to read his own disclaimer. This conversation is for educational and informational purposes only and does not constitute personalized financial, legal, or tax advice. Individual circumstances vary, and listeners should consult a qualified financial planner, tax professional, or attorney before making any decisions about their own situation. For up-to-date information on benefits and eligibility, including unemployment insurance, health insurance options, and retirement or severance rules, visit trusted sources such as careeronestop.gov, healthcare.gov, ssa.gov, and opm.gov. So now let's get into the conversation. And before we dive into some of the financial steps, I just want to acknowledge what a lot of people are feeling. We are recording this while we are still in a government shutdown. I hope that by the time that it airs, we will be pulling out of it. But even with the government shutdown and furloughs, a number of people are feeling job loss and experiencing job loss across every single industry, every single sector. And when I've talked to friends, clients, or even reflected on my own past experiences, and we can talk about that, Mike, here are some things that come up often for people. And I want folks to just know and acknowledge that they're not alone. Things like, I feel stupid. I should have saved more money. What do I do when my next rent payment is due? Do I tell my landlord now or do I wait and fall behind? Should I use credit cards or will that make things worse? Should I borrow from my 401k or thrift savings plan or cash it out? Should I ask my family for help? What do I do about groceries or healthcare for my family? I'm single. What do I do now? Or I'm the backup plan for everybody else. What do I do now? I'm scared my credit score will tank before I find a new job. How do I recover from this and make sure it never happens again? And I think really the overarching question and the thing that's on a lot of people's mind is, am I going to be okay? So Mike, this is really where I want to start, because most people, before you have the spreadsheets and the financial advisor conversations, many of them may not have a financial advisor. But what's the first thing you tell someone when they just got the notification that they've lost their job? What is the first thing that you would advise, both in your experience and professional, leveraging your professional expertise? And again, thank you so much for being with us.
Hey, listen, it's a pleasure to be here. I really appreciate you inviting me to be a part of this conversation. The first thing, and it's interesting because everyone thinks of me as a numbers guy, right? As soon as I say I'm a financial planner or a wealth advisor, they assume that all I do are spreadsheets, numbers, figures, charts, graphs, right? But I'm part-time, kind of like a psychiatrist, thinking about people's mental health, right? So I would start with the first thing that I want to help people address is, just getting their mental capacity together. It could be very traumatic to be impacted by a layoff or your job is eliminated. So I first want to have people pause and just, allow themselves to breathe for a moment, to get their mind back together. Then we can start talking about, okay, what are next steps? To me, the first step would be, let's consider what are your top priorities? All right. We need shelter. We need food. We need clothing. We need transportation. Let's kind of, spend a moment to evaluate what those figures are. Let's take a look at the resources available to us within our household to address those needs. And then I kind of walk through more details with a family with a household.
Let's talk about what you can do to supplement or bridge the gap. Should I apply for unemployment insurance or wait until my severance runs out? Or should I apply at all? Or if I apply for unemployment insurance, is it charity? Let's help destigmatize unemployment insurance and demystify what it is and the purpose that it serves.
No, absolutely. I think it's a great question. So the first answer is people should apply for unemployment benefits as early as possible. Even if we're expecting a severance, you can begin the process of unemployment. And you can imagine, like you mentioned at the beginning of this conversation, we're in a government shutdown, right? So we need to be pushing things forward as aggressively as we possibly can, right? So apply for unemployment right away, as soon as possible, even if you're expecting severance. So let's say hypothetically, I'm expecting 90 days worth of severance. I would still apply for or consider applying for unemployment benefits right away to get the process going. And then you can always report, hey, listen, I'm expecting 90 days of severance. And then really what you're trying to do is set yourself up for the beginning of unemployment as soon as possible after severance or whatever package you might be expecting, goes away. I think you bring up a great point. It feels like we're taking a handout when it comes to unemployment. I can't imagine, what it feels like to fill out that paperwork. However, remember, part of your deductions from your paycheck, month to month, week to week, is going towards unemployment insurance, right? So it's kind of like car insurance. You're paying the premium. When you get a car accident, you better believe that's a positive thing to have that benefit. So I think unemployment is similar, where you're paying into the system along the way while you're, gainfully employed. So consider taking advantage of that benefit if and when you need it.
What about health insurance too? Because I think that that's something that we tend to separate outside of the financial conversation, but it's really part of the financial conversation in a really big way, almost to the tune of a third or 25%. If you think about your overall benefit package or comps and benefits, what is the smartest option with respect to healthcare insurance once you lose your job and you lose your healthcare?
No, absolutely. And I first think about how important it is. We are all potentially one, illness or car accident or injury away from, a major medical bill. So that, I try and drive home how important it is to have some form of coverage. Really, when we lose employment, the first option to consider is usually what's called COBRA, COBRA. What that means is you're able to continue your employer-sponsored benefit. However, it's to the tune of you're paying 100% up to 102% potentially for that premium for the health insurance.
So it's expensive. That's a big check.
That is a big check. And it can be very jarring, right? Because, we thought it was expensive while we were working. Try paying 100 to 102% of that bill. All right. Yeah. So especially in a time of lower income, right? So you're losing income and the expectation you're going to pay significantly more for health insurance. So, that's one way. I usually consider that's the quick, immediate solution when you leave a job. Typically, a lot of jobs offer the opportunity to convert to COBRA. The other opportunity is the Affordable Care Act, ACA. Obamacare. Really, the idea there is you go to your state marketplace and you're basically shopping for a type of health insurance coverage that suits your needs as well as your budget. So generally, COBRA and the Affordable Care Act marketplace are two places to get potential medical benefits.
And is the reason why that's more affordable the fact that it's tied to your income? Your rates are tied to your income and your tax status, et cetera. So it's not going to be the same for everybody.
That's correct. That's correct. So a person that is significantly lower income than literally another person in the same state may pay a different premium amount. They have what's called subsidies. And so if you're in a certain income bracket for that year, now when we say income, we're not necessarily meaning just work. There are other ways to generate income. So for example, saving and investments, those are considered income as well. So long story short, we want to make sure that you're aware that the premium can be based off of how much income your household makes in a particular year. So there's potential that it might not be as expensive as you're thinking.
Yeah, I think a lot of times when we just don't know, it's not as bad as you thought, but you do have to face it. Okay, so let's talk about what do I do with and I'm reading some questions here that we have. What do I do with my 401k, 403b, or thrift savings plan, or my pension plan? Do I cash it in and use it? Do I leave it alone? What are my options? And I'm going to add another caveat onto the question. There's not a lot in there. And I just feel like I can just take it and use it right now to pay the bills. So if you could say from 21, 22 to 30, first things first, what do you do with whatever it is that you have in that account?
Certainly. So let's start off with, I guess the short answer would be pause. Let's evaluate what would be best for you. Because one of the temptations is, hey, let me just cash this thing out real quick and keep it moving, and now I have some cash to pay my bills. That might be the answer, but I would prefer to do a proper review, analysis of cash flow, what assets are available, what income's available to pay bills before you cash in. So think of it this way. When you cash in your 401k in your 20s and 30s, you are under the age of 59 and a half, which means you're not only going to pay taxes, you're also going to pay a 10% penalty on dollars that you cash in on your 401k. So just a simple illustration, you might be taking home 60 to 65 cents on the dollar. All right. So be careful, before you cash in a pre-tax retirement account. And that's an important distinction, pre-tax versus after-tax or Roth. All right. So Roth money is treated differently than pre-tax. So we'll hang out in the pre-tax space. Most people are contributing to the retirement account pre-tax. And so that means, there's a penalty, 10% penalty plus income taxes for whatever you cash in on that retirement account.
So just let's put some plain numbers. Let's say that you are the person and I'm saying this exact example because we've talked about this, who was between 21 and 30, listened to the elder statesperson colleague who leaned over during benefit enrollment time and said, hey, Mike, I want you to max out your 401k. And you did that. And you got the company, you maxed it out, you got the company match, and now you just lost your job and you're 28 and you realized you have $30,000 in your 401k. And I mean, is that a realistic number, by the way? Because it could be.
It's absolutely. I mean, let's do some quick math. So in 2025, the max you can put in a 401k is $23,500. Mm-hmm. So, I mean, a person could, that age bracket could, in theory, put, $23,500 in the account plus the employer match. So we have potential to get there in 1 year.
If they're making that much money, right? But let's just say they could be making $40,000 a year, right? And so over 5 years, it might have grown, especially in this past market with index funds being what they are. It may have grown through their contribution, the employer match, and interest over time, it might have grown to $25,000. So
That's fair.
going back to your example, you got $25,000 sitting in your 401k. You just learned notification that you've lost your job. Your annual salary is somewhere in the area between $40,000 and $50,000 a year. Okay. And you're looking at this money sitting in there, and you cash it in and you walk away with
65 cents on the dollar, right? So using simple math, right? So I have $10,000. I'm walking away with 6,500 instead of, keeping the 10,000 and perhaps finding another way to pay my bills in the short term.
And even if they write the check for 10,000, by the way, you're still going to have to pay 3,500 the following April.
The government is going to find you. Okay. So, and think of it this way: the employer, when they cut you that check for whatever the amount is, they're reporting it to the federal and state bureaus, right? So everyone's going to be aware of this transaction. And typically, the employer will withhold the penalty and tax. Sometimes it's optional, sometimes it's not. So definitely worth considering. If you're going to cash in a retirement account, you're typically going to receive significantly less after taxes and penalties.
Okay. So that's 21 to 30. Let's go 31 to 50. You have $100,000 in your 401k and you just lost your job. And it's harder for you to find a job. It might take you longer to find a job that pays even that amount of money. But what do you do now?
I would say it's a similar situation, right? Because you're still in that potential 10% penalty as well as ordinary income taxes. So, to your point, life probably gets a bit more serious in that time frame, right? More responsibilities. Again, I would caution if you can, avoid withdrawing from that benefit or from that, balance. Please do so. But sometimes that's what it calls for. I've seen over the years, I've been doing this 15 years now. I've seen households where, hey, listen, that is the remaining asset to pay the bills. Guess what? We need housing and food and utilities and all that good stuff. So if that is the case, so be it. I guess my advice is really just let's take a look at the big picture before we start liquidating and taking some penalties and paying taxes, because perhaps there's a strategy to avoid that situation. Let's say, for example, you're able to get a bridge job that offers a 401k. And let's say you can roll over your 401k to the new job, and the new job offers a loan against the 401k. That might be an option rather than liquidating, taking a 10% penalty plus taxes, rather than, liquidating. Hey, maybe we can take a small loan out and get us through, until we get back to our career-oriented job. So that's something to consider.
Right. And you call it a bridge job because it may not be permanent, but it may be something just provide some income. But you can borrow against the 401k, but only if you're employed with that particular employer. And if they have the plan set up that way.
That is correct. So I always direct people to look at, there's a document typically called the SPD, the summary plan description. So before you leave your job, I recommend, if possible, reviewing as many, documents about your retirement plan, your benefits, just so you have details on what's available to you post-employment. But yeah, while let's say hypothetically, I'm working for company A today, I'm laid off, 30 days from now. Now what? I do not have the opportunity to take a loan against that 401k in most cases. Again, look at your summary plan description of that particular plan. But in most cases, you can't take a loan against an old 401k. Also, you typically can't take a loan against an IRA. So if you roll over your funds from a 401k to an IRA, you're going to have to either withdraw the funds or find another way to pay the bills.
Right. So, but you're saying even at both of those stages, early career and mid-career, you're really looking to preserve retirement savings as much as possible. But if you have to use them, be strategic in the way that you're drawing down and pulling them out. And it's sort of last resort in your mind?
It's a last resort in my mind, mostly because of the penalty, right? The penalty and the taxes. If there's a way to avoid that, let's do it. But again, if that's the remaining, asset to help us get through this season, so be it. And then also we incorporate into the plan. Okay, so we need to take some money. We need to pay taxes and penalties. What does that look like, in the next season? And we plan for it moving forward, and we keep moving forward.
I'm going to come back to this notion, but I only learned that by having open, vulnerable conversations with people I trust that actually know what they're talking about. So, but I think that people might think, oh, it's all the same, but taking money out in November is not the same as taking it out in February or March. It's just not the same.
That's going back to the word strategic, right? Yeah, we want to be strategic. I find a lot of people get, personal and financial advice from loved ones, neighbors, coworkers. Not every scenario works for every person in every season, right? So just because your coworker did X, Y, Z when they were laid off doesn't necessarily mean it applies to you in the same way. So definitely one size does not fit all.
All right. I still want to address the last segment, the fly and ageless and aging segment, or 50 plus. I'm in the 50 plus, so that's no shade. Segment. What about folks who are 51 plus, 55 and over, or even have the option of so-called early retirement or rewirement? What should you do with those 401ks, again, TSPs, 403bs, and or your pensions, if those still exist at your job? And they may, in fact, if you've been at a company that has a more traditional retirement benefit plan.
So great question. I think of it as, instead of using the term retirement, I like to call it financial independence, right? When do you want to have the option to work?
I want it now. No, I'm just kidding. Keep going.
You said I want it yesterday. All right.
Yesterday.
So I completely respect and appreciate that. Yeah. So let's say hypothetically a person, and actually a key age that I want to bring up is 55. All right. So there's something called the rule of 55s. Essentially, let's say a person turns 55 this year. Or they're beyond 55, between 55 and 59 and a half. There is a potential opportunity to take funds from a retirement account penalty free. I didn't say tax free, but I did say that 10% penalty can potentially get waived for someone that is 55 years old, recently laid off, and they'd like to take funds from. By the way, the big caveat is they have to leave the funds with the current 401k plan. So they cannot roll it over to an IRA and apply the rule of 55, and they can't roll it over to new 401k and then apply the rule of 55. It needs to be the employer that they were laid off from.
Can you take it from an IRA, though, that exists?
So the rule of 55 does not apply to IRAs.
Okay.
It applies to your funds are with the employer 401k. And that's an important caveat, because a lot of people, to your point, I'm out of this company, I'm out, right? So they take the funds, they roll them over, whatever's tied to the company, they move them as far away from the company as possible. Sometimes that might not be the most strategic decision. There's nothing wrong with it, by the way. So, my thought is, again, let's be strategic and consider, where we are in the season and what is best for us. Sometimes it might mean leaving the 401k, TSP where it is. Okay, so I would say in that like you said, that fly 50s,
yes,
sassy
double
60s,
nickels,
hey, all that. All right, so let's talk about that age, situation. I would say let's be especially strategic, right? Because in that age bracket, to me there might be more potential strategies, whether it's tax or risk, as opposed to the 20s or 30s. So in my mind, let's take a pause. Let's review household financial situation. That includes taxes, that includes cash flow needs, right? And then we'll take a look at the retirement accounts and evaluate, does it make sense leaving it? Does it make sense rolling it over to a new 401k, new employer retirement plan? Does it make sense rolling it over to an IRA? Does it make sense withdrawing portions at a time? Everyone's situation is different, so I wouldn't give one specific answer, but I would say probably some more options some more opportunities open up in the 50s, 60s, 70s.
We're going to keep going. And if you have the appetite for it, I have the appetite for it. I have additional questions. Let's do it. By the way, if you're watching this on YouTube, please put your questions that you have in the chat. Don't be shy, or send us questions at info@giantstepsllc.com, and we might answer it on a later broadcast or get back to you individually. Okay, so Mike, I have a question for you as it relates to Social Security, because we may have some watchers, listeners, viewers that are approaching 62, and or which is for some an eligible age, or 65 is the first Social Security normal retirement age, or whatever it is, and they may be thinking about taking their Social Security benefits. Can you help us understand what's an official Social Security retirement age? Should you take it out? Is there sort of a cash value of money equation that we should be doing relative to Social Security? How should we think about Social Security benefits if you are in fact eligible?
Sure. So when I think of Social Security, the first thing that I describe is the age range. So Americans can begin taking Social Security at 62. That's assuming that they've worked, they call it 40 quarters of work history. You are eligible for Social Security benefits. Earliest age
40 quarters is 10 years broken down into quarters. So it's
correct.
10 consecutive years, or 5 plus another, whatever it is, 40 quarters.
Correct. 40 quarters is the threshold to become eligible for Social Security benefits. All right. So 62. The next number is what we call full retirement age, FRA. And by the way, you can download your Social Security statement. That includes your work history, that includes your estimated benefits at ssa.gov. So 62 is the first age. That's the earliest you could take it. The next age we talk about is full retirement age. I usually describe that for most people somewhere between 66 and 67, depending on your birth year. Again, that'll be on your estimated benefit statement. The third number that we describe is 70, age 70. So think of it this way. If someone takes their benefit at 62, it's going to be a lower amount than their full retirement age, 66, 67, and it'll be even lower amount than 70, okay? So think of it this way.
How much lower?
Oh, sure.
How much lower?
So let's break it down. Okay. So let's say most people should consider, I'm not telling anyone what to do, should consider waiting until their full retirement age, which means that you're getting your full Social Security benefit. Now, remember, you've been paying into the Social Security system your whole career, right? So this is partially funded by you, all right? So long story short, let's say most people consider taking it at 66, 67, okay? If I decide to take it a year earlier than my full retirement age, so let's say my full retirement age is 67, and I decide to take it a year early, I'm going to take approximately a 5% discounted benefit. And for each year from full retirement age down to 62 is an additional 5% discount. So people could be missing out on 25 to 30% of their Social Security benefit if they take it at age 62. Full retirement age, somewhere around 66, 67, again, depending on your birth year. Now, if you think you might have a long life expectancy, your parents, your grandparents lived to 90s, you may consider delaying beyond your full retirement age. So an example would be my full retirement age is 67. I wait until 68 to begin my benefits. I'm actually going to increase my benefit by approximately 8%. So from full retirement age to age 70, each year you delay, you're bumping up your benefit approximately 8%. So on the way down is 5% discount. On the way up is kind of an 8% bump in benefit. Now remember, Social Security benefits potentially are forever, right? So if I live from 67 to 107, I'm going to collect this benefit year over year. Another factor is what's called a cost of living adjustment. So it's not a static number. From time to time, the benefit may increase. The government deems that and there's inflation and they need to increase their benefit. But key age is 62 is the earliest that you can take Social Security. full retirement age for most people alive now is somewhere between 66 and 67. And then if you'd like the additional benefit, you can wait until age 70. I find that most people take it somewhere between 62 and full retirement age. And the biggest factor is, one, do you need the money? I have some people that I work with, some households that, listen, perhaps they were laid off at 56 and, they're just making ends meet. And by the time they hit 62, they need to take that Social Security benefit to make their household, able to pay their bills. In other scenarios, if you have the opportunity to postpone, I strongly recommend considering that. If you have a health condition that might say, hey, listen, I don't have a expectation of living for a very long time. My father, unfortunately, he passed away at the age of 74. He started his Social Security benefit at 62. For his situation, it worked out because he got the maximum amount of Social Security that he could. However, if he lived to 88, perhaps he shortchanged his, income from Social Security.
So net, just wait as long as you can, but be strategic about it. And it depends.
It depends. And that's really, the moral of the story is, everyone should consider what is best for their situation.
All right. Should I use the cash that I have to pay off debt and to feel lighter? Or should I hold on to every single dollar that I have? And that's a great question because unemployment might be extended beyond what you thought. And it's just sort of a good thought experiment for us to all be, pondering. What do you think?
So I guess my thought is, let's again be strategic. So let's use an example of, your cash flow is extremely, extremely tight. And we're concerned about paying the housing, the key expenses, housing, food, utilities, transportation, et cetera. I would focus on that. I would say if we find that there's surplus cash flow, perhaps we consider, eliminating high interest debt. By high interest, I kind of define that by, let's call it 8% or more, 9%, 10% double digit interest, typically credit cards, right? Student loans. I would probably in that season pay the minimum because obviously we're trying to maintain our credit rating, right? However, if we don't have sufficient cash flow to cover our household expenses, I would start there. And then, you and I could talk a bit more about, what do we do with the debt, if we're unable to make payments. But I would say, if we have the option to pay down debt, and we're able to take care of the basic, needs, I would say that's fine. And if you have the surplus cash flow to continue paying down debt, perhaps that, some people I find like to make extra payments on their mortgage. Perhaps we're not making extra payments. Perhaps we're paying the minimum mortgage payment, minimum student loan payment, minimum credit card payment until our income situation changes, just to be conservative. I know that it might feel better to aggressively continue paying down the debt. I guess my thought playing it through is, let's fast forward now. We've aggressively paid down the debt. It's 9 months later and, severance has ended. Let's say it's a year later and unemployment has ended, or 2 years later, unemployment has ended. And now we're really tight, as opposed to we could have been a bit more conservative with our cash until we had that next, job to juice up our household income again.
I want to talk about student loans, and I do not want to talk about the regulations, the repayment or the forgiveness programs, because I really don't even know where they are right now. But for the majority of people who are in a student loan, they have student debt and they have student loans. They also have the option to reach out to their lender and ask for a forbearance. It doesn't mean that you don't have, that the monies are not owed. They are in fact still owed, but a forbearance would be an option where you wouldn't be required to make a payment for a particular set amount of time if you negotiate that, or you could talk about it with the lender. So either you're postponing payments altogether or making a reduced payment. while you are unemployed. The interest still accrues. Do you recommend that people take up that option to preserve cash and liquidity?
It's a great question. I would say the response is, unfortunately, like most of my answers, it depends. I guess my initial thought is, communicating with whoever, the entity is, whether it be student loans, credit cards. I think that a best practice would be, especially if it's prolonged. I mean, if you're unemployed for a week or two, perhaps, you might hold off until, you may have a job opportunity, a month or two later. I think my thought is, if you think there's going to be a prolonged, hey, listen, it's going to be 1 month, 2 months, 3+ months, we're unable to pay our debts, then I would recommend considering communicating with those entities, credit card company, student loan company as examples, landlord. And I think communicating with them, hey, listen, this is my current situation. I would definitely document the communication. You're trying to be a good citizen, right? And notify the entity, hey, listen, I've fallen on difficult times. And then if there are programs available, such as forbearance, again, you consider it. I think that, there's always the consideration of, if I take action in a certain way, does it affect my credit score? Does it affect my standing financially? So that's why I wouldn't give a hard and fast answer, but I just want to give you all something to consider.
What if I don't have an emergency savings account? What if I don't have, because most people don't have 6 months to a year of cash sitting just in case something happens? I don't even know the statistic, but I think I read somewhere a really frightening statistic that so many people are paycheck to paycheck that they are one missed paycheck away from homelessness. So what can I do if I don't have an emergency fund or emergency savings? What's like the most important thing for me to do in that instance?
I think really that's the time to take a look at what assets are available, right? So you started the conversation with retirement accounts. Again, if that is the last asset available, perhaps we use that to bridge us to get, through the season. Perhaps you have valuables or collectibles. Again, I'm just, giving you ideas of potential assets, sneaker collections. I mean, I know that's
Perkins.
Hey, listen, forgive us for even considering it, but in a tight spot.
No, it's real.
It's so real, right? So in a tight spot, we have to take a hard and fast look at what do we have available to take care of us through this season. So I would start, we're back to pen and pad or Excel spreadsheet, however you do it. Just creating a list of what's available for us to use. I guess the other thing is to look at, or maybe do an online search for, perhaps there are programs available. My mother volunteers with a local program that provides food assistance, right? Perhaps that's it might not feel great, but it might help reduce the stress on the household if you can reduce your food bill. All right. There's to me, there's no shame in taking care of your household. All right. So I would just, again, try and do an analysis of what resources, whether it's in my home or outside of my home, that's available to help take some of the stress off. And then it hopefully clears up some mental and emotional space to do some planning moving forward.
Yeah. Part-time jobs to provide supplemental income, driving Uber, selling some things that you just no longer need, being, more discerning about your spending, bringing in a roommate, reducing your rental expense by going home and living with your parents if that's possible, and removing the shame around your agility to do those things when and if you need it.
Well, and then also, I think it's very similar to a medical condition, right? So let's say, I feel something in my chest and I'm like, you know what, I'm just going to leave it be. And it gets worse and worse and worse. And then I end up in a hospital somewhere because something that I could have addressed 3 months ago got 10 times worse. So I feel like finances are similar where, hey, listen, let's, and you said this very early on in this conversation, let's take a look at it. Let's take a look now. And it is what it is. and let's come up with some strategies moving forward. And again, there's no shame in taking care of home and taking care of yourself.
Yeah. My last question for you, and certainly we can talk about anything else that you have, but what's one financial habit that you think makes the biggest difference through a career transition or job loss or a layoff?
I think the biggest item that we need to focus on is expenses. And the reason why I say expenses is because, again, we need a roof over our head. We need clothing, shelter, utilities, transportation, right? So I think, and again, unfortunately, unemployment might be a trigger event. I do think it's a healthy habit for all of us to be at the very least aware, right? So periodically, whether it's weekly or monthly or quarterly, take a look at your statement, whether it's your credit card statement, your bank statement, know where the money is going, and make an intentional decision. Should I be spending this money in this season on these items? Mm-hmm. You and I both know we should be enjoying this life, right? So neither one of us are telling people to stay at home and never go out, never have some fun. At the same time, we have to be realistic about situations. So I think tracking expenses, there are plenty of ways to do that. I've noticed that most banking apps, allow you to track your expenses, and they have budgeting tools. If you have any questions, please feel free to reach out to me. I'm happy to chat more about that. But I really think, managing your expenses as well as possible for things such as the important stuff that we talked about. And then also saving, if there is any opportunity to save anything towards the emergency fund to help protect your family, just in case the car breaks down, just in case the air conditioner goes, just in case fill in the blank, in this scenario, we're talking about just in case you lose your job. I do think it's extremely important whenever possible to stash some cash away for a rainy day.
Absolutely. And Mike, this has been fantastic. And I know you have a YouTube series, but that provides more information. How can the viewers and listeners access that information? Where can they find you and even reach out to you if they want to work with you, or if you fit into the profile of people, if they reach out to you, if they fit into the profile of people with whom you work? What's the best way to reach you?
No, absolutely. So I work with people nationally. So I'm not limited to the New Jersey area. We have phone and web. So just wanted to put that out there. So my office number, 201-626-6688. And my email address is mdaniels@ffgus.com. I do have a YouTube channel, so I encourage you guys to come check it out. It is Mike Daniels, CFP. Mike Daniels, CFP as in Certified Financial Planner. You can also find me on LinkedIn. I post those videos there as well. If you go LinkedIn, Michael V. Daniels, and there's an opportunity to book an appointment on my LinkedIn profile, or feel free to shoot me an email or give me a call, and look forward to connecting.
Mike, thank you so much for taking the time to be with us on Giant Steps with Leilani Brown, and I will speak to you soon. Thank you so much.
Thank you so much for having me. Speak to you soon.
This podcast is a production of Giant Steps, LLC, a company working at the intersection of strategy, culture, career, and education. I'm Leilani Brown, CEO and host of the show. Many thanks to Jaira Michael, our executive producer, and S. Maxwell Brown, producer and editor of this episode. You can learn more about our company at giantstepsllc.com. We hope you enjoyed this episode and others. Please be sure to follow, like, and share our show far and wide. Thank you for listening.